Welcome to the ETF Show, taped here at the Asset TV studios in New York. I'm your host, Kristen Myers, ETF Editor-in-Chief for Asset TV. Private market access inside the ETF wrapper is one of the newer innovations that is exciting investors. As the private credit market is growing, access to publicly traded companies is shrinking. Brown Brothers Harriman research has found that publicly listed U.S. companies has declined by 50% since the 1980s, while private assets account for nearly $15 trillion of deployed or committed capital. And that figure is set to increase to as much as $25 trillion by 2030. But even as interest grows, there are still concerns about placing illiquid assets inside a very liquid wrapper. Here to discuss more is Jerry Pryor, COO and CIO of Managed Futures at Mount Lucas Management. Jerry, thank you so much for being here with us.
Yeah, I'm glad to be here.
So, Jerry, taking the 10,000-foot view on this, what do you think is really driving this trend right now to bring private market exposure inside of the ETF wrapper?
Yeah, I think it's an extension of what's going on in the past decade here with private assets in general. Post GFC, with Dodd-Frank, you saw banks pull back their lending and their participation in the capital structuring of companies, and ultimately what ended up happening was that moved into private assets, private equity, private real estate, and private credit, which in particular has grown tremendously over the last 4, 5, 10 years now. And I think what people, the goal to bring this into the ETF wrapper, to bring it to the retail client is to give access to retail investors when institutions have had access to for the last decade.
So as you're mentioning, the past decade, we're really seeing this interest really start to increase. Are you seeing, however, at the same time, investors really question how much liquidity they want inside of their portfolios?
Yeah, and I think there's a couple good points around this. One, the liquidity is something of a consideration for a retail investor, because what the ETF wrapper, it leads to confusion. While you have liquidity within the ETF wrapper, the underlying constituents might not be liquid. And in any time markets start to freeze up, what you think is a liquid investment, a liquid ETF investment, is not, where the underlying instruments don't have that pricing liquidity. The other thing, I think, and I think in general this happens with private assets in general, is people kind of lump them into the alternatives bucket, and by alternatives, they sometimes confuse alternatives with diversification. And I think it's important that people understand that private equity, private credit have the same underlying economic drivers that public equity and public credit have, except they're far less liquid and in a different structure. What's going to hurt public equity and public credit, market crises, stress events, is also going to hurt those same private assets. So when people start thinking about alternatives and diversification, they need to think. We see a lot of assets coming back into hedge funds now, and hedge funds, and particularly in the liquid alternative hedge fund space, managed futures, global macro. Those types of strategies are actually out there providing real diversification with liquidity in the underlying constituents.
To that point, it sounds like in your mind then that investors, they think that they're diversifying, but essentially they're just increasing equity and credit exposure, correct?
Yeah, we sort of coined a term internally. Instead of calling them private equity and credit alternatives, we call them equalitives. They're sort of equal. They're equal to public equity and public credit, but they have the same underlying economic drivers, but there's that underlying illiquidity, and they certainly aren't diversifying.
So then when private markets get put into this ETF wrapper, what changes and what doesn't change?
Yeah, I mean, for me, my concern for retail investors is they're looking to these things as a way to diversify what they already own in their sort of traditional, whether it's in 401ks, or if they have some sort of 60/40 or target portfolio. that the addition of these things somehow gives them a more diversified portfolio, and I just don't think that's the case. I think it has its risks to market stress and market sell-offs, while maybe hidden for, given the stale pricing that goes on in these markets, maybe hidden for some periods of time. Eventually, uh, the real risks of those underlying investments, you know, could be severe.
So then, really what happens to that diversification then when markets, like they have been, pretty volatile? Volatility seems to be the theme of 2026. When markets are selling off and everything is moving together, then what does happen to that diversification?
Yeah, and I think that's why investors need to be, thinking about, areas like managed futures, global macro, sort of, we saw in the 2000s, a lot of sort of those traditional hedge fund strategies that have sort of, taken a back seat to the assets being raised in private markets. But those traditional hedge fund strategies, if you think about managed futures, you have the ability to be both long and short the bond market, long and short the US dollar, and long and short commodity markets. That provides real diversification to portfolios, and it's access to returns that portfolios normally, traditional portfolios, private portfolios, don't really have access to. Nothing. Managed futures got you short bonds and long commodities in 2022, which is the exact right place to be, and long bonds and short commodities and during the GFC. Those are real diversifying exposures being added to your portfolio, giving optionality to, a wider range of market type stress events. So I think it's important that, they know what they buy. Just buying more of the same, which is an okay thing to do, but it's, if you're looking for diversification, I think, more consideration should go into the underlying strategy.
And not to really, put too fine a point on this when it comes to this liquidity problem, right? I'm curious if you can kind of just go a little bit further on how that illiquidity really impacts an investor's ability to rebalance during times of volatility, since it seems like the ETF wrapper is giving or has this risk of an illusion of liquidity that doesn't actually necessarily exist.
Yeah, I think that's that's a great point, because when particularly in a world of diversification, when you're looking to add things that diversify your portfolio, and there could be some confusion of whether the private markets do that or not. But in a case, if you have something that is trying to diversify your portfolio, that diversification doesn't mean anything unless you can harvest that diversification or monetize that diversification, and you can't do that without liquidity. And you know, if you look into a particularly like a a period of market stress, uh, GFC would be one of them, or in the middle of COVID, when markets aren't pricing well. The one thing you want with your diversifying investment is, if it's working when everything else is getting killed, you have to be able to sell it and rebalance back to target weights, and make yourself a buyer of equity when it's on sale. The problem with these private, my concern, with these private assets, is they won't price during a period of market stress, which means you may think it's doing better than it really is. And, if that price were real, you'd be selling it right there, because it's not real. The real ability to use those private assets and rebalance and stay on your target weights, and stick to your asset allocation, it makes it difficult. And ultimately, what happens in a period of stress is you end up with one side of the portfolio just not pricing, while the other side of the portfolio is going down. And then all of a sudden, you thought you had a 20% allocation to privates, and now you have a 30% allocation. And that was never your intention. In a world where, particularly once you are retired and you're taking disbursements out of that portfolio, that can be a real important thing. If you end up with a lopsided portfolio where you can only sell your public stuff, and you're stuck with more and more and more on the private side.
So you've touched at this a little bit, but then for true diversification, where should investors look if they are, rethinking private markets?
Yeah. So, our firm, Mount Lucas, is, we're in the business of providing defensive and risk mitigating strategies, managed futures being one of them, global macro being another. You know, I, my bias clearly is towards those types of investments that, truly diversify what goes on in traditional portfolios, plus has the underlying liquidity that you can monetize when it's doing well in a period of stress. Um, and I think just investors have to keep in mind, and when they're going into alternatives, making sure that there's enough diversification in there with enough liquidity to meet their goals.
So then talk to us a little bit about how managed futures like your fund KMLM, and I'm going to read the full title. It's the Crane Shares Mount Lucas Managed Futures ETF. How do funds like that fit into that conversation?
Well, they access a different risk premium, right? So futures markets exist to transfer price risk that businesses and companies that face interest rate risk or currency risk or commodity price risk. Those prices are exogenous to their business if they don't have any control over large changes in price, and they need to go to futures markets to hedge those risks away so they can efficiently run their businesses. What we do in the managed future space is systematically accept that price risk. Uh, we do that through a process called trend following. And that really, for us to, when we do well, is when prices are moving and markets are volatile. We correlations going to one. All those things are a tailwind to our type of strategy. We do well in periods of inflation, periods of deflation, so we could be on either side of that coin. And um, you know, all the things that drive a strategy like ours are the things that hurt equities. So, you know, from a fundamental nature, the risk premium we're getting out of the futures markets it's just a different risk premium than equities and credit, which are more of a capital structuring risk premium, where business and companies go to investors to raise capital to build and grow their companies. That's a different world. Private equity and private credit are exactly the same thing, uh, but the risk premium we get out in the futures market's entirely different, and that's why it really diversifies.
So then, considering all the volatility, the geopolitical tensions that we have going on lately, in your mind, then liquid alts are they better positioned than private markets in an environment like we're in right now?
To give an example of the current market, our strategy came in to March long energy and commodities, um, but also long bonds, right? So the long bond piece hasn't done well, but the long energy stuff has done extraordinarily well, which is why we're up a few percent this month, and doing a really good job of diversifying in sort of a stress period here. I mean, it's not the end of the world for stocks right here. I mean, maybe down 5%, 4 or 5% off highs. So it's not really stressful yet. But there's certainly a path to get there. If this type of environment were to continue, energy prices stayed high, inflation stayed top of mind, bond prices probably would go down. We'd probably start to get short bonds here. Um, you know, th- this would, this type of if this environment continues, I think it's going to, an equity bond portfolio is going to really struggle, whether it's public or private. We have the ability to get access to types of distributions, that might do well here.
So this trend of these launches is not going away. So as we do see more
No.
launches and more innovation, right, in the space of
Yeah.
private markets and ETFs, what do you think that investors should really make sure that they don't misunderstand about the space or even about these products?
So, I don't have anything against investing in private assets. Whether they're bringing private equity and private credit inside the retail wrapper. I think there needs to be some education around that. I think you should really think about not confuse the ETF wrapper with liquidity. and probably limit the size that you're willing to do in your portfolio, right? So, you know, whether and that depends on what your individual investors' comfort levels are, but 5, 10%, and 20% it needs to be on the low end. I wouldn't certainly wouldn't fill up my portfolio with these things. I would, you know, is there alpha generated in the privates? Yes. I mean, historically they've shown pretty good alpha, but they do face the same economic risks and stress risks that other markets face. And I think the liquidity has to be a concern, that you may want to get out of these one day and the gates might shut. Yeah.
And a lot of private market funds are seeing that happen right now as they're capping some of those
They are. It
redemptions.
seems
So
it seems like every day we open the newspaper, there's more gates. Yeah.
absolutely. Jerry Pryor, COO and CIO of Managed Futures at Mount Lucas Management, thank you so much for joining us today, and thank you for tuning in to the ETF Show.